Good morning, Bitcoiners. Hello, and welcome back to another edition of your economic calendar. I'm Mauricio Di Bartolomeo, co-founder of Ledn, and as with every week, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is Tuesday, February 8th, and we have an excellent episode for you this week. In today's issue, we're going to take a look at U.S. inflation data. We get another reading of U.S. inflation for January this week, and we're going to look at what the markets are expecting and how they could react based on the results. Additionally, we're going to be looking at Tether and stablecoins. Tether dominance among stablecoins has dropped from 50%, from below 50% now for the first time ever. And we're going to look at some of the implications around that. And last but certainly not least, we're going to take a look at the SEC, which last week delayed the decisions for Bitcoin ETFs applications from both Bitwise and GBTC. So we're going to look at some implications based on that. Grab your coffees, everyone. It's going to be a great one today. And starting as we usually do with Bitcoin, we see that Bitcoin closed last week up by 11.8%, closing last week at $42,420. And we see that it has now had, including the previous week and last week, it has had 2 consecutive weeks of gains. So far, we're into the 3rd week of gains. We are still far from the weekly close. But this consecutive back-to-back green weeks had not happened until essentially, last time this happened was around essentially early November of last year. So while price action has been positive as of late, we see that the spot trading volume has been relatively low. These are the 3 little bars that you see here for the 3 most recent weekly volumes. The biggest news out of last week in terms of Bitcoin, there was a few actually, but some of the biggest news out of last week was the fact that the SEC delayed the ETF, Bitcoin ETF applications for both Grayscale, Bitcoin Trust, and Bitwise fund. We're going to pull up a few headlines around this in a second. This is the Bitwise decision, and then we'll also pull up the GBTC one as well. Now, as you know, there have been several applications submitted into the SEC to create spot Bitcoin ETFs. After denying 6 applications since November, the SEC has recently issued 2 notices requesting further information about 2 particular Bitcoin ETF applications, and those are Grayscale and Bitwise. The first one that you see here is the one, the article around the delaying of the Bitwise spot ETF, and right here is the article referencing the delay of Grayscale's decision. So in both cases, the SEC has asked for additional information and requested commentary from the public and or interested parties around these applications. The news, the request for comments, and the fact that both applications were delayed rather than rejected was received favorably by markets, as it signals that the SEC is not necessarily closing the door entirely to the possibility of an approval. Now, having said that, if we take a look at the GBTC premium or discount from its traded shares, essentially relative to the price of its assets, we see that that discount is still in pretty much record territory at negative 25%, close to negative 26% in terms of a discount. So while the news of the delays were encouraging, price action suggests that investors have not necessarily adjusted their expectations. Analysts polled and referenced in these articles also agree that the probabilities of an approval this time around are still pretty low. For reference, the decision on GBTC should come out at some point prior to July 6th, so sometime this spring or summer. Now, the other big news in the Bitcoin world that dropped yesterday was that Tesla, and this is the article that you have behind the headline, Tesla announced yesterday that it still held essentially $1.99 billion worth of Bitcoin at the end of 2021. Again, you can see the article here, but this means that essentially Tesla kept a sizable chunk of the Bitcoin that they purchased well back. And despite having posted a $101 million accounting loss, it has also posted $128 million of realized profits. And theoretically, based on the initial purchase price and some of the transactions that have been reported, it could be sitting on an implicit gain or an implied gain of around $500 million for the Bitcoin that it has kept. So pretty powerful news, and we saw what happened last time Elon Musk and Tesla got behind Bitcoin. Now, looking at the Bitcoin futures markets, we're starting to see some backwardation on some of the curves, and this we wanted to highlight here. Let's just pull up the futures curves. 1 second for the Bitcoin futures. So if you can see, these are the curves essentially for the Bitcoin futures. And backwardation, just as a refresher, simply means that the future price of Bitcoin is trading lower than the current price of Bitcoin. And we're actually seeing this across several curves right now. Pretty much all of them, except for CoinFlex, seems to be the only one that is not showing some backwardation. So again, just to kind of clarify why this is so important, normally these curves slope smoothly upwards and to the right. And the fact that it is dipping, the fact that you see this type of dip and slope, means that the charts are essentially pricing in lower future Bitcoin prices than the current Bitcoin prices. And this is referred to as essentially backwardation. Additionally, if we continue looking in the futures markets, we see that the funding rates for perpetual swaps have remained negative even as the market rallies. And we wanted to show you. So these here are the perpetual swap funding rates for Kraken, Deribit, and BitMEX. BitMEX we see is negative territory, so is Deribit, and so is Kraken. So again, these are perpetual future swaps that are in negative territory. And again, this has remained in negative territory even though Bitcoin has been rallying for the last 2 weeks and so far into the third week. And when Bitcoin rallies, funding rates are not typically negative, as funding rates reflect which side of the trade typically has more leveraged investors. So if more contracts are long, the funding rate will be positive. If more contracts are short, the funding rate will be negative. And so what we are seeing as the market has rallied is that there is negative funding rates, or there are negative funding rates, meaning that there are more people short the contracts than long the contracts. And this is not typically what you see during a rising price environment. Now, lastly, just to take a look at the shorts, if we look at short interest in Bitfinex, which we have been covering here for the last little bit, we see that it remains quite elevated and in fact has not really dropped in light of the recent 3-week rally. So all of these factors, what we just pointed out in the futures curve, in the funding rates, as well as the short interest here, all of these three suggest that investors are still hedging for some downside, even in the face of the current positive price action. There are some interesting implications to the current positioning that we're seeing in the market. For one, since leverage seems to be building up to the downside, this creates a setup where drops could theoretically not be as deep because people are leveraged and looking for down price action, not up price action. So the liquidations actually will happen if price moves upwards, because this is where the leverage is essentially now looking for downside. So if the price moves upwards, this is when the liquidations on the futures leverage would potentially happen. And this would result in the price melting upwards and the price action of a short squeeze, which we've referred to or described here once before, which is essentially the opposite of people getting liquidated on the long side. People just become overweighted short and they become liquidated to the upside. So while this concept sounds exciting, this idea of melting upwards, it's important to not forget the fact that the Biden administration has a looming potential order to task federal regulators in the US with regulating digital assets. So while this is still a rumor, the news could certainly introduce volatility if and when it happens, and this could be what some investors are trying to protect against. So more details in our What's Ahead section. Moving over to the S&P 500, we see that it's been a volatile last few weeks in equity markets, and this has been essentially as central banks across the world look to elevate interest rates to cool down their economies. And before we get into some of the market price action activity, let's just pop up some of those headlines that are being referenced around. So the headline that you have here essentially discusses, or just as Wall Street Journal is essentially highlighting, that the 10-year Treasury yield surged above 1.9%. And these are levels, again, not seen since before the pandemic. And the interesting thing here is that while this looks like a fast increase for the 10-year bond, and then we're just going to show that here. This is the yield on the 10-year bond. This is what it's done. And now, while this does look impressive, look at what's happened to the yield on the 5-year bond. It's even steeper. And if you think that's steep, look at what's happened on the yield on the 2-year bond. And that's even steeper. And so what's happening here is that essentially interest rates are going up across maturities, but the short-term interest rates, the shorter the duration of the bond, the faster the interest rate is rising. And we want to show essentially the comparison here so that you can see the one you have on your screen right now is the yield on the 2-year US bond. We're going to add here the yield on the 5-year bond, the yield on the 10-year bond, and the yield on the 30-year bond. And what we'll see here, I'm just going to place those yields 1 second. All right, so we're going to place here, this is the 2-year bond, we're going to add the 5-year bond, we're going to add the 10-year bond, and we're going to add the 30-year bond. Oh. So here you can see this green bars represent the yield on the 2-year note, the blue line represents the yield on the 5-year note, orange on the 10-year note, and yellow on the 30-year note. So as you can see, the 2 years one that's risen the most, followed by the 5-year, followed by the 10-year, followed by the 30-year. So what this means essentially is that the market is pricing much higher interest rates in the short term, so between the next 2 to 5 years, and much lower interest rates or yields in further out, so between 10 to 30 years. So what you are seeing essentially here is that the yield curve, the yield curve is just a fancy way of saying the sequence of bond interest rates at different bond maturities. So for instance, the overnight rate is 25 basis points. The 2-year rate is 1.3%. The 5-year rate is 1.8. The 10-year rate is 1.9. The 30-year rate is 2.2. So the longer the maturity, the higher the interest rates. So that is just what the yield curve means. Just a fancy way of saying the further out the bond, what is the different interest rates, right? And as we've discussed, the shape should should basically naturally slope upwards and to the right. So that is what the natural state of the yield curve should be, or is typically. Investors demand a higher rate of return for committing their funds for a longer time frame, as there can be more uncertainty over a longer period of time. Now, when the short-term rates are as high or higher than the longer-term rates, the curve can become flat, right? We basically, if you price the interest rates of a 2-year the same as a 30-year, the interest rate is flat. There is a situation where the 2-year interest rates could be actually higher than the 30-year interest rate bond. And this is referred to as the yield curve inverting, meaning the investors are demanding higher interest rates for overnight or short-term borrowing than they are for very long-term borrowing. So what we have been seeing and what has been happening since the beginning of the year is precisely that. The curve is flattening. The interest rates for the much shorter durations are going up way faster than the interest rates for the much later durations. So let's take a quick look at what typically happens when the yield curve inverts, or when a further out interest rate becomes lower than a shorter out interest rate. What you have on your screen is the difference between the yield on the 10-year note minus the yield on the 2-year note. This number, as we've described in a natural setting, should be positive because the yield on the 10-year note should be higher than the yield on the 2-year note. As we can see here, there have been periods of time in history where these curves have been inverted, meaning the interest rate on the 2-year note has been higher than the interest rate on the 10-year note. This has happened several times in history: 1, 2, 3, 4, 5, 6, and 7. And we can see that every single time that this has happened, it has essentially led to an economic recession. after the yield curve gets inverted. Basically, you can see here that 6 months after a curve is inverted, typically, we get hit with a recessionary period. What we are seeing now is that the curve is flattening. The difference between the 10-year and the 2-year is becoming increasingly smaller and is trending essentially towards zero. And based on this graph, we can see what could happen next if and when this difference gets into zero or negative territory. So again, these are, bonds are trending in that direction, and it's getting increasingly closer to that critical level. So we are going to continue monitoring this relationship between the 10-year and the 2-year note and the steepness of this curve going forward. Now, this issue is not just isolated to the US. We are seeing short-term bond yields soar across Europe as well. And that has led to the recent Reuters headline that says that sub-zero euro yields may actually be near their end after the current ECB pivot in terms of their monetary policy stance. So again, equity markets, just going back to the charts, I'm just going to take off these yields so we can take a look at the charts more clearly. As we can see, equity markets have been holding pretty strong, even with soaring yields for now. And this has largely been on the back of strong fourth quarter earnings that have been reported by some companies, a lot of sectors, and also the energy sector has been very, very strong given recent oil prices. But however, just on that note, given the soaring oil prices, here just for your reference, just to take a look at how high oil has soared. It's basically at $90 from $17 in April of last year. So almost 5x over the course of the last year. So oil prices are soaring, interest rates are rising, and these two things usually combine after a long enough period to bring markets under pressure. And this will happen particularly if inflation numbers remain high and we get another read of US inflation this week. So we're going to get more details around that inflation read in our What's Ahead section. But again, it wouldn't be surprising if rates keep rising and if oil prices continue to soar, that we're going to see some potential headwinds in equity markets. Moving over to gold, we saw that after a pretty rough week it had in the last week of January, last week it rose by almost 1%, 0.91%. And we see that this, so far this week, 2 days into the week, it's already up another 1%. Interestingly, there was a report released last week by the IMF that essentially highlighted that central banks became net purchasers of gold essentially for the month of December and added net 14.2 tons of additional gold to their reserves. Additionally, in the gold side, and this just touches on crypto as well, there was a Japanese trading house, Mitsui, which is a very prominent Japanese trading house, announced that they're planning to issue a digital currency pegged to gold, and the proposed name is Zingpang Coin. This is the article on your screen right now. This would be Japan's first gold-linked cryptocurrency, and again, given the issuer, it could have some adoption if and when released. And the firm Mitsui also disclosed that this asset would first be sold through Mitsui's exchange, and it would also have goals in the future to list the asset in other exchanges. So interesting here for gold in terms of price action or where we could be headed. As we know, gold reacts pretty closely inversely to the real rate of return of U.S. bonds. As we've seen, these yields have been soaring, and when real yields rise, it basically works against gold. But what we're seeing right now is the rates of return, the yields on these bonds are rising, and inflation seems to be holding steady. So if the real rate of return of these bonds continues to improve, we could see some pressure on gold. So a lot will depend on that inflation reading that we get later on this week. Moving over to DeFi, we see that it was a wild week in the DeFi space. Price-wise, both the DeFi index, which we see here, rose last week 16%, and Ethereum rose last week by 17.5%. So both the DeFi index and Ethereum rose by more than 15% last week. And there were several significant events throughout last week. First up, let's do an update on the stablecoin landscape. And for that, we're going to pop some data from Skew around the market cap of stablecoin contenders. 1 second. So this is the chart you see right here. I'm just going to make it a little bit bigger so that it's easier. So as we can see here, this chart basically tracks the market capitalization of all stablecoins except for Tether and compares that to what the market cap of Tether is. As we can see, historically, Tether has been more than half of the entire market capitalization of all stablecoins. In fact, if we go back to just a year ago today, all other stablecoins combined were only 30% of Tether's market cap. Fast forward until last week, and for the first time ever, we saw all other stablecoins except for Tether combined now surpass the entire market capitalization of Tether, which means that essentially Tether is now less than half of all stablecoins, of the universe of all stablecoins. So that is it just speaks volumes to the sheer demand that we've been seeing and the sheer growth that stablecoins have experienced over the last year. And this is a trend that we expect will continue. So again, very, very interesting and very promising for the future growth of stablecoins. Now, elsewhere in the DeFi world, there was a prominent DeFi platform that suffered an exploit and was hacked for $325 million. This was allegedly after an error on GitHub. Now, Wormhole, which is the protocol or the project that got hacked, is a decentralized bridge between Solana and Ethereum, meaning it allows assets from one protocol to be exchanged for assets from the other, essentially, in a trustless way. So we'll get into that. Within 24 hours of the hack being announced, of the $325 million being drained, Jump Trading, a Chicago-based trading firm with over 20 years of experience in traditional markets, stepped up to provide the $325 million needed to make the protocol users whole again, which is a pretty big step to take. The hack was reportedly the fourth largest hack in crypto history, and it was larger than the Quadriga CX hack that many people know happened in Canada a few years back. Now, for full context, Jump Trading has a vested interest in the success of Wormhole. And this news here references that essentially Jump Trading bought Certus One, the software development firm that was one of the main contributors behind the development of Wormhole, and they bought this company in August of last year. So again, the hack once again highlights the risks of DeFi at a time when regulators have their focus on the industry. So we will continue to monitor any progress or updates from this particular hack. And moving over to our Bitcoin mining commentary, we see that Bitcoin's network difficulty reached a new all-time high last week, moving to 26.69 terahashes. We are essentially at all-time high territory once again. After fully rebounding and recovering all the China exodus. Taking a look at the mempool, we see that it remains clear as well, with transaction costs and processing times at optimal levels for Bitcoin. And as always, we wrap up with what's ahead for the week. So Bitcoin seems to be riding a high after the Tesla announcement yesterday. And the next big test for markets may be January's inflation data that comes out of the US this week. The data gets released at 8:30 a.m. on Thursday. And analysts expect year-over-year inflation to come in at 7.2% from the previous 7% in December. So still a marginal uptick from the December rates. Month-over-month inflation for January is expected to come at 0.4%, and that was 0.5% in December. So the expectations are for a quite large reduction in the month-over-month inflation rate relative to December. Now, any surprises to the upside on that number could cause headwinds for markets. Conversely, lower than expected numbers could also be celebrated by markets. And this all ties back to what the Fed needs to do in reaction to these numbers. Now, we're going to wrap up essentially by breaking down some of the other data and relevant earnings that we can expect for the rest of the week. So Tuesday today, we get earnings reports from KKR and Lyft. Tomorrow, Wednesday, we get earnings reports from Uber and Motorola. At 10:30 a.m. Eastern tomorrow, we get a speech from Fed Governor Michelle Baumann. And at noon tomorrow, we also get a speech from the Cleveland Fed President Loretta Mester. On Thursday, we get earnings reports from Twitter, Western Union, and Eventbrite. And it's the big inflation data day. At 8:30 a.m. Eastern, we get consumer price index month to month and year over year. At 2 p.m. on Thursday, we get the U.S. federal budget. And at 7 p.m. on Thursday, we get a speech from Richmond Fed President Tom Barkin. So we've covered a lot. Thank you for watching and for reading. If you enjoyed the show, if you learned something, if you liked our content, or if you enjoyed it or if you laughed, we welcome you to thumbs up, share it, and subscribe to our channel. Share it with your friends. If you don't yet have a Ledn account, I welcome you to check out Ledn.io and see how you can start earning the best interest rates for your Bitcoin and USDC. And we also have the best rates for loans if you have Bitcoin, don't want to sell your stack. And we just launched our brand new Bitcoin mortgage, which lets you buy a house as big as your stack. Thank you, everybody. Have a wonderful week and see you next time.